Lesson 3. The core concepts that actually make a strategy work. Let me start with something you've probably seen. You open a trading chart for the first time, and someone has layered a dozen colored lines on top of the price. Moving averages, RI, Massachusetts, CD, Bollinger Bands, all squiggling around. It looks like the cockpit of an airplane. And you think, if I could just understand what all of these mean, I'd finally know when to buy. So you spend a week reading about each one, and somehow you feel more confused than when you started. Every indicator says something slightly different. Half the time they disagree. The chart still looks like a mess. This lesson is about getting past that. The indicators themselves are not the hard part. The hard part is understanding what a strategy actually is, what those indicators are for, and how you go from, I have a hunch, to I have rules a computer can follow. Once you see the structure, the indicators stop being intimidating. They're just tools. What a strategy really is, I want to start here, because the word strategy gets used loosely and it muddies everything. A trading strategy is not an opinion about where the market is going. It is not a feeling. It is a fixed set of rules that answers 3 questions in advance, before any trade happens. When do I buy? When do I sell? And how much money am I willing to lose if I am wrong? That is the whole thing. If you can't write down your answers to those 3 questions on a piece of paper, you don't have a strategy. You have a vibe. In Freqtrade specifically, a strategy is just a Python class. You inherit from a base class the framework gives you, and you fill in methods that say, here is how I compute my indicators. Here is my entry logic. Here is my exit logic. The framework handles the rest, fetching data, placing orders, tracking positions. Your job is the rules. The first chunk of those rules is entry logic, the conditions under which you open a position. A classic example is the golden cross, which is when a short-term moving average crosses above a longer-term one. People read that as the short-term trend getting stronger than the long-term trend, and they buy. Or you might buy when RSE, which I'll explain in a minute, climbs out of oversold territory, or when price breaks above its previous high. Any of these can work. None of them always work. The second chunk is exit logic. When do you get out? This is the one beginners ignore, and it is the one that actually determines whether you make money. You might exit on a death cross, the opposite of a golden cross. Or when RI pushes into overbought territory. Or more commonly, when you hit a profit target or a stop loss. And the third chunk, which I'd argue is the most important, is risk management. How big is each position? What is the maximum loss you'll take on a single trade? How many positions can you hold at once? You can have brilliant entry signals and still blow up your account if your position sizing is reckless. We'll come back to this. The different flavors of strategy before we get into indicators. You should know that strategies tend to fall into a few families, and the family matters because it tells you what kind of market the strategy was built for. Trend-following strategies try to ride sustained moves. They buy when an uptrend starts and hold until it ends. They shine in clear bull or bear markets, and they bleed in choppy, sideways markets because they get whipsawed in and out of trades over and over. Mean reversion strategies assume price tends to come back to its average. They buy when price has dropped unusually far, and sell when it snaps back. These work beautifully in range-bound markets and painfully in trending ones, because in a trending market, unusually far down, can just keep going down. Breakout strategies buy when price breaks through a key level, betting that the break will lead to a sustained move. Momentum strategies are a close cousin, basically betting that whatever has been going up will keep going up for a while longer, because the strong get stronger. The reason I am telling you this isn't so you memorize 4 categories. It is so you understand that no strategy works in every market. A great trend follower is a disaster in a sideways market. A great mean reversion system gets demolished in a strong trend. When you build something, you have to know what environment it was built for, and you have to watch for that environment falling apart. What technical indicators actually are okay? Indicators. Let me demystify them. A technical indicator is just a mathematical transformation of price and volume data. That is all. You take the raw numbers, the open, high, low, close, and volume for each candle, and you run some formula over them to produce a new number that is supposed to tell you something about the state of the market. Trend, momentum, volatility, whatever. They are not magic. They are not predictions. They are summaries. RE summarizes recent up moves versus down moves. Bollinger Bands summarize recent volatility. The indicator is a lens. It doesn't add new information. It just reshapes information that is already there so your brain, or your code, can act on it. Let me walk through the handful you'll see over and over, because once you know these you can read most strategies. Moving averages. EMA and SMA, a moving average, is the average of the last N closing prices, where N is some period you choose, like 20 or 50 or 200. As each new candle comes in, you drop the oldest price and add the newest. So the average moves with the market. There are two flavors you need to know. The simple moving average, SMA, treats every price in the window equally. The exponential moving average, EMA, gives more weight to recent prices. That is the only real difference. But it matters. The EMA reacts faster to new price action. The SMA is smoother. Which one is better? Honestly, it depends on what you want. EMAs are more popular in crypto strategies because crypto moves fast and people want signals that respond quickly. SMAs show up more in traditional equity analysis where you care about the big picture. The classic use is the crossover. You plot a fast-moving average like the EMA over 20 candles, and a slow one like the EMA over 50 candles. When the fast line crosses above the slow line, that is a golden cross, a buy signal. When it crosses below, that is a death cross, a sell signal. Simple, intuitive, and surprisingly hard to beat with much fancier methods. ASE, the Relative Strength Index ASI, is a momentum oscillator. It compares the size of recent up moves to the size of recent down moves and squashes the result into a number between 0 and 100. The textbook reading is that above 70 means overbought. The asset has run up too fast and might pull back, and below 30 means oversold. It has fallen too far and might bounce. The default period most people use is 14. Here is the honest caveat though. In a strong uptrend, RI can sit above 70 for a long time without anything bad happening. You'll watch a coin climb 40% with RSI screaming overbought the whole way. And if you shorted it the moment it hit 70, you'd get destroyed. So overbought doesn't mean sell immediately. It means the momentum is unusually strong to the upside. Pay attention. Same thing in reverse for oversold in a downtrend. The more useful signal a lot of traders find is when RSI crosses the 50 line. Above 50 means average momentum is positive. Below 50 means it is negative. And there is also divergence, which is when price makes a new high but RSI makes a lower high. That disagreement can be an early warning that the trend is exhausting. Bollinger Bands. Bollinger Bands are a volatility indicator. You compute a 20-period simple moving average as the middle band, and then you draw an upper band 2 standard deviations above it, and a lower band 2 standard deviations below it. The band widens when volatility is high and narrows when volatility is low. The intuition is that price spends most of its time inside the bands, so when price touches the lower band, it is stretched unusually far below average, which is a mean reversion buy setup. When it touches the upper band, it is stretched unusually far above, which is a sell or take profit setup. The other thing people watch is the squeeze, when the bands narrow sharply. That tells you volatility has dried up, which historically tends to precede a sharp move. The bands don't tell you which direction the move will go, just that something is probably coming. MACT stands for Moving Average Convergence Divergence, which is a mouthful, but the idea is straightforward. You take the difference between two EMAs, typically the 12 period and the 26 period, and that difference is the MACT line. Then you take a 9-period EMA of that MACD line, and that is called the signal line. The histogram is just the difference between the two. When the MACD line crosses above the signal line, that is a buy signal. When it crosses below, that is a sell signal. Same crossover logic as the moving averages, just applied to a derived line. And when the histogram is growing, the trend is accelerating. MACT is one of those indicators that gets overused because it looks pretty on a chart. Don't stack it on top of 3 other trend indicators and call it confirmation. They're all reading the same underlying data. More on that in a second. How signals are actually built. Okay. This is the part that ties it together. In Freqtrade, you don't write code that says, buy now. You write code that, for every candle, computes a bunch of conditions and marks a column in a data table, with a 1 if all the conditions are true, and a 0 otherwise. The framework then sees the 1 and places the trade. So your job is to design those conditions. And here is where most beginners make the same mistake. They take one indicator, like the RSI dropping below 30, and they fire a buy signal every time it happens. That gives you a lot of signals, and most of them are noise. The fix is to combine conditions you use and logic when you want multiple things to be true at the same time. Golden cross and RI recovering from oversold and volume picking up. All three have to be true, or no trade. That filters out a lot of bad setups at the cost of missing some good ones. You use or logic when any one of several conditions is enough. RSI below 30 or price touching the lower Bollinger Band. Either one is a reason to look for a bounce. What you generally want is a small number of conditions that confirm each other without all measuring the same thing. A common pattern is one trend filter, one momentum trigger, and one volatility or volume check. For example, price above the MA20 confirms the trend is up. MACD positive confirms momentum is bullish. RE climbing back above 30 confirms a recent oversold condition is reversing. 3 different lenses, each adding a little information. The Freqtrade bundled strategy called strategy. 1 is a good teaching example. Its entry logic is basically 3 things. The EMA20 just crossed above the EMA50, the golden cross. Price is above the EMA20, which confirms the trend isn't just a flicker. And the Heikin Ashi candle, which is a smoothed version of the price, is green, meaning the smoothed close is above the smoothed open. 3 checks, each measuring something slightly different, all pointing the same direction. That is the shape of a sensible entry. Stop loss and take profit. Where the money is actually made, I want to spend real time on this part, because it is where strategies live or die. A stop loss is the price at which you admit you were wrong and get out. In Freqtrade, you can set a fixed one as a percentage. Something like -5%, meaning if the trade goes 5% against you, you close it. Simple, predictable, blunt. The problem with a fixed stop is that markets have different personalities at different times. 5% in a quiet market is enormous. Basically never gets hit. 5% in a volatile crypto market is nothing. You'll get stopped out on routine noise. That is where trailing stops come in. A trailing stop follows the price up. You set it to activate once you are in profit by some amount. Say 1%, and then it sits a fixed distance below the current price. As price climbs, the stop climbs with it. If price falls back to the stop, you exit. But you exit in profit. Let me give you the numbers. Say you buy at $100. You set the trailing stop to activate at 1% profit, so it turns on at 101. You set the trail itself at 2%, meaning the stop sits 2% below the highest price since activation. Price climbs to 105. Your stop is at 102.9. Oh, price keeps climbing to 110. Your stop is at 107.8. Oh, now price reverses and falls back to 107.79. The stop triggers, and you exit with about a 7.8% profit. You gave back a little from the peak, but you locked in most of the move. That is the whole appeal of trailing stops. They let your winners run while guaranteeing you don't give it all back. Take profit works differently. Freqtrade uses what it calls ROI, return on investment, and the clever bit is that it is time-based. You set a table where the profit threshold drops as time passes. At minute 0, you might demand 10% to exit. After 30 minutes, you'll settle for 5%. After 60 minutes, 2%. After 120 minutes, 1%. The logic is honest and human. If a trade immediately shoots up, great. Take the big win and move on. If it has been an hour and the trade is only modestly green, don't be greedy. Take the small win and free up the capital. If it has been 2 hours and you are barely up, just close it. The setup clearly isn't doing what you expected. You can also exit on signals, not just on price levels. You write an exit trend that fires when, say, a death cross appears or RSI pushes above 70. So in practice, a strategy has 3 exit mechanisms running at once. The fixed or trailing stop protecting you from disaster, the ROI table taking profits on schedule, and the signal-based exit responding to changing conditions. Whichever triggers first wins. And then there is the question of how aggressive to be. An aggressive setup might use a tight 3% stop, a tight trailing trail, and quick ROI targets. That means lots of small trades, lots of small wins, lots of small losses, capital cycling fast. A conservative setup uses a wider 10% stop, no trailing, and ROI targets that stretch out over hours. Fewer trades, bigger moves, more patience required. Neither is right. They're just different bets about what kind of market you are in and what kind of trader you are. One thing to take with you if you remember nothing else from this lesson. Remember this. Indicators are tools, not oracles. Every one of them is just a different way of summarizing the same price and volume data. Stacking 10 of them on a chart does not give you 10 independent opinions. It gives you 10 views of the same opinion. A good strategy is one where you understand exactly why each rule is there, what question each indicator is answering, and what kind of market the whole thing was designed for. When the strategy stops working, and at some point it will, that understanding is what lets you diagnose why. That is lesson 3. Next time we'll get into data, where it comes from, how you download it, and why the quality of your historical data quietly determines whether your backtests mean anything at all.